Good morning, everyone. I hope my mic situation is taken care of. I'm going to just do a quick mic check on my phone because I don't want any problems during the stream. So let me just do a quick mic check just to make sure. Unfortunately, whenever I go live, I have to view the video in order to see if my audio is good. I won't know if it's good unless I'm streaming. All right, that looks good so far. Okay, so let's get started, guys. We're going to do the stream just a little bit different today. Usually I'll go through the news and things like that, but I was kind of like looking at it halfway. I got to get this fan going. I was looking at it halfway, and I was like, man, we already have enough doom and gloom out there in the markets. Like, why continue to add to it? So we all know the market is red, right? We know the market is red. I don't have to, explain that to you guys. We're going to cover it briefly, but I want to move into kind of this long-term thinking, right? Because there's probably some investors on this channel who haven't been investing that long, or investors who, might see this video and they've never been through a correction of some sort, right? Whether you're in an index fund, individual positions, high yield income ETFs, or, any mixture of the bunch, it's good to sometimes take a step back and look at the bigger picture. All right, look at the bigger picture, look at the long-term prospects that can come after a bear market, or that can come after a huge downturn or a market correction, right? Because right now, yes, it is very scary. Yes, it is horrible that this is happening. And, it's outside of our control. There's really nothing we can do about it. But, if you're a long-term investor and you're in it for the long run, right now could be a great opportunity to get in, right? It doesn't matter if you're young or mid-age or whatever. Right now could be a great opportunity to get, some of your favorite ETFs, some of your favorite, individual stocks or whatever on sale. All right, so let's just get into the stream and we'll take it from there. Okay, so again, I hope the mic is coming in just fine. But we're going to start off with just, quick fear and greed index. This is produced by CNN. Obviously, there's extreme fear. I mean, we already know that. Market open. So this is the pre-market for Friday for, Eastern Standard Time. This is going to be the pre-market. So looking little spicy, looking a little spicy, definitely a lot better, when compared to yesterday's pre-market. So we're looking a lot better, right? I did see some green earlier when I checked this. Obviously it went down a little bit. I'm going to just keep an eye on this overnight and just see how it goes. But, yesterday, or today rather, was a huge sell-off. And I know it's racking some nerves, especially for some new investors or some investors who, have never been through a downturn. This is nothing new. These things happen all the time, right? They happen. What comes after is what, fuels excitement, right? The idea that you can get double your return or even triple your return in the year or the years preceding. So you have to keep that mindset. So like I said, this stream is going to be a little different, guys. We're not going to go over too much news because there's already a lot of doom and gloom out there. I'm just going to cover the markets at a very high level, and then I'm going to get into the show. Again, I changed the stream mid as I was doing my morning research. And I was like, you know what? Again, there's enough doom and gloom out there. Why keep adding to it? So we're going to take a different approach today. Obviously, nothing was safe from the bloodbath, but consumer defensive doing pretty well. Companies like Coca-Cola, Pepsi, doing really well. PM is Philip Morris, excuse me. Sin, tobacco, that kind of thing. PG is Procter & Gamble. You have McDonald's doing well. Let's see, J&J, United Health. All right. So we have a little bit of green in here. Obviously nothing from the tech sector, right? Nothing from technology, nothing from financials. Even real estate had a huge sell-off, right? Even real estate market had a massive sell-off. Actually, I think it was down three and change, overnight. So pretty scary, right? Nothing was safe. Absolutely nothing was safe from the sell-off. So this is all stemming from the tariffs. Of course, this is out of our control. We can't control this. We don't know what's going to happen. We're not on the world stage. We're not world leaders. We can't control, really outside of voting, right? Every 4 years, we can't control what the government or the administration is going to do. All we can do is position ourselves and react to it or, you know, take a wait and see approach. So the all in what was it, the I forget what this is called, the American Association of Individual Investors survey was updated. So last week we were looking less bearish. This week we're looking way more bearish than the preceding couple of surveys done. So this is just a survey of, you know, just investors, no name investors. I don't know who these people are. I'm sure you don't. You can sign up for free if you'd like to add to it. But, you know, basically the question comes up every single week. What direction do all AAII members feel the stock market will be in the next 6 months? And it's looking pretty bad, right? But again, this is just investor sentiment. This is just, you know, a data point that you want to keep in the back of your mind so you can kind of understand where everyone's mindset is. But, you know, you don't need a survey to understand that. You can easily look at the stock market, look at YouTube, look at the news, and just see where all, you know, where everyone is. And not just that, but you can also read the comments and get all that stuff. Hey, Crouching Tiger. Yeah, I'm from the future today. So again, this is I'm going to skip a lot of the new stuff, and I want to just take you guys down kind of like this memory road. And I'm going to apologize in advance if this stream is going to come off as kind of like hacky, you know, ad hoc-ish, because I did put it together kind of like in the last, you know, 30-45 minutes, because I wanted to change kind of the theme for today. Because again, there's a lot of fear right now, so I don't want to keep adding to it. So right now we have tariffs. A worst case scenario puts the S&P 500 at risk of up to 20% downside. Right now we're sitting at about 10%, if I'm not mistaken. If we look here and if we look year to date, yeah, so we're about from all-time highs. Yeah, about 12%. So it's about 12% from all-time highs. So, you know, we have more to go. At least I think we probably have more to go. But tariffs, worst case scenario, puts the S&P 500 at risk of up to a 20% downside. So, you know, if you're holding tech stocks, you know, Tesla, Amazon, Netflix, Google, Apple, those types of companies, they probably have a lot more downside to go. So let's take a quick look down memory lane. All right. This is from Market Watch. Let me make this a little bigger for you guys. So this is from Market Watch. A bruised stock market looks to the Fed for relief. U.S. stocks had its worst start to December since 2008. Now, this was not published recently. This was published in 2018. Okay, this was published in 2018. I had to go back in the time machine and dig up some stuff because I want to show you guys that, yes, we are in peak fear right now. We're in peak pessimism. The sky is falling. Everything is blowing up. The government's going to go bankrupt. What else is there? The trade war is going to go on. The U.S. is heading into recession. All this stuff is always like it's like clockwork. It always comes every couple of years. And, you know, we seem to be just fine after the fact. But I just want to show you guys some of these articles. Again, I don't know how long the stream is going to last. Hopefully not forever. But with 3 weeks left until the end of 2018, both the Dow Jones Industrial Average and S&P 500 are mired deep in the red. And it will be essentially up to the Federal Reserve to determine whether the stock market extends its winning streak for the third year or takes a breather. Now, this was at a time when our current president had his last administration, okay? This was at a time when there was a huge potential global war trade or a trade war, rather, and it was going to involve the United States and China as the tipping points, right? They were at this inflection point, or this, whatever you want to call it, this decision where they had to decide, you know, do they want to really go into a trade war with each other, because this would affect the entire world. So then we had massive stocks selling off. We had everything selling off at this time, at this period in time, right? So this wasn't that long ago, guys. This was not that long ago. Here's another one. Stocks are getting whacked as global growth fears mount. Again, another article from the same period, right? This was right after everything started to recover and we started seeing greener days. But again, still, you had a lot of fear in the news about this global growth fear, right? That, you know, countries were going to head into recession. The United States was going to have, you know, halting growth and all this other stuff. Same exact language that you see everywhere right now, right? And again, all of these articles will be linked down below in the description at the conclusion of this stream. But yeah, it's the same kind of speak, right? It's the same kind of talk. We've seen this before, right? Here's another one from PBS of all websites from December 27th, 2018. 6 factors that fueled the stock market dive in 2018. 2018 was not a good year for the stock market. Since the beginning of the year, the Dow Jones Industrial Average has lost about 10% of its value, as did the S&P 500. The NASDAQ dropped roughly 8%. The vast majority of losses have come since October, when the stock market, which was experiencing the longest bull run in history, took a turn for the worse. All right, so here's those factors. Tariff driving uncertainty. Right, the Trump administration, again, Trump administration's tariffs on imported aluminum, steel, and other goods have introduced a large amount of uncertainty into the global economy. And we had another one, the Federal Reserve and interest rates. All right, what are we dealing with right now? Almost the same thing. History does not repeat itself, but it rhymes. All right, and that's a motto that I like to remind myself of whenever I read or go into like finance books and things like that, because yes, we've probably been through this at a different time, period in time. I read an article about at some points during, I think it was like the 1950s or something, and the late 1800s, where the United States put tariffs on a bunch of countries, and it basically did not go well. And as far as the Great Depression, it actually extended the Great Depression because of the tariffs. But again, maybe this time is different. Who knows? But the Federal Reserve and interest rate hikes, the Federal Reserve raised interest rates 4 times this year, right? And what are we expecting the Federal Reserve to do now? We're expecting them to drop interest rates because we're still fighting inflation, et cetera, right? So again, they're always going to be in the news. And then what else we have? Big tech under scrutiny. Surprise, surprise, right? 5 major tech companies, Facebook, Apple, Amazon, Netflix, and Google, make up 11% of the S&P 500 index. Okay, tack on NVIDIA, tack on Tesla, and boom, now we're at the Magnificent Seven. Okay, but again, same story that we've seen before. And this was back in 2018, this article came out. Yeah, 2018. So in December of 2018, we saw the Christmas rally, right? The winter rally, whatever you want to call it. And, we were expecting the same thing to happen last year. That did not happen. And, people are like, well, what happened? Well, sometimes people just tack on these names to events that happen and expect it to happen every single year. Not the case, last year anyways. But yeah, same exact thing. Inflated company earnings. We have GOP tax cuts. Right now, I believe the House is trying to get basically the TCJA, the Tax Cuts and Jobs Act, version 2.0 passed. So I know that's being done right now. So we're kind of waiting to see what is going to be the outcome for that. And then you have the stock market is not the economy. Well, duh, right? But again, same exact stuff you see all the time in the news, right? Same exact stuff. This happened 2018 again, when China and the United States were about to enter into a very severe trade war. So I just want to check the comments real fast. Good morning, everyone, and thanks again for joining. Let's see. RB, happy face. Hey, welcome. I don't think I've seen you on the stream before, so welcome. Let's see. Bear markets buy Lambos. Hell yeah, that's what I'm talking about. Well, yeah, now you got to add that 25% tariff because because the Lambos are coming from overseas. Galveston County Mike says, many of us seasoned investors are not prone to the news-driven panic that affect markets. I'm sitting on a little dry powder, cash, and will likely buy a little Tesla and others. Hey, that's what's up, man. See? That's what's up. That's the mindset we need to have. This is an opportunity to buy. Rook says, I'm cool as a kitten, sheltered my cat while doing puts. Excellent. Awesome. I'm still trying to learn how to do cover calls. Not much progress there, but I am working on it. I just haven't really sat at the computer and went through the material yet. I know a couple people sent me a bunch of videos that go over it, they recommend it. So I'll take a look there shortly. Mike says the stock market is not the economy. Exactly. Right. That is the truth. A lot of people have that misconception. I had that misconception myself when I first started. And I mean, looking back now, it's like, man, I really sounded dumb. But anyways, beside the point, let's continue on with the stream. Okay, so U.S. stock markets rally after pre-Christmas slump. All right, so again, this is another one from 2018. All right, stock market went up. Everyone's happy, euphoric. Everyone's starting to dump more money in. everything's looking good, right? Everything's looking green. So here's another one. Stocks post best January since 1987 as S&P 500 climbs 7.9%, right? And again, the story just continues going on. What I want to show you right here is how bad that dip was. Okay, we went from 2,800 points, a high of 2,800 points in November, down to 24, probably closer to 2,300, right? That's a severe drop. And this was all panic induced. This was peak investor pessimism. This was all news driven, everything else. I mean, the trade war could have escalated, could have turned into something horrible. But look at what happened after, right? After we finally reached the bottom, well, first let's take a look at what was going on here, right? On this downward slump. Very volatile, right? You thought you were good, and then no, it just went down, right? It looked like I heard one YouTuber talking about a W shape, like we're setting up for the W. I don't know what the hell that means, all right? The technicals and all that stuff, but I don't know. This looks like a W, I guess, or a U, and then it just slumped even lower, right? So, what I'm saying here is, it's going to be bumpy. It's going to be a very bumpy ride these next couple of weeks, definitely these next couple of months. I'm kind of just throwing dates out there, and I'm really predicting about May, June is when we'll probably see greener days, right? Like probably better days. The Federal Reserve is expected to drop interest rates. There's a prevailing theory out there that, Trump is, kind of doing this whole tariff stuff for a couple different reasons. One, negotiation tactic for other countries. Two, to force the Fed to lower interest rates even faster or even more. And then three, of course, is, so he can set himself up for this tax bill that he's trying to get passed. So again, all these things are happening simultaneously. And we as the investor, we as the people, as market participants, excuse me, are dealing with the volatility in the markets, right? We're dealing with our 401ks turning into 201ks. We're dealing with our portfolios dropping by 10 or 15 or even probably as much as 20%. So we're going to be on the shit end of that stick, at least for a couple of months, right? So I just wanted to show you guys this, right? And again, I apologize if this is an ad hoc-ish, jumping around type of stream for today, because I did change the stream last minute. I didn't want to go over all this, negative news. The sky's falling, right? So I wanted to kind of just take a trip down memory lane and show everyone what we've been through, and we seem to be okay, right? So don't sell at the lows, right? Do not sell at the lows is what the point I'm trying to drive here, because we can have greener days in the future. You just have to hold on. All right. So this is a chart for, what was it? I put it, did this update? I really hope not. No, this, yeah. Okay. Excuse me. So this was August, I think. No, October into December, and then into January 2019 of the new year, right? So this was the chart for when the trade war was happening with China between the United States, right? Same thing, tariffs, all that good stuff. I mean, look at that drop, right? Pretty bad drop. Scared the living hell out of people. We did not fully recover until about April. So we saw the drop happen, we'll call it October, and we didn't fully recover until about mid-April-ish, right? And then, we had another slump, and then we saw new all-time highs, in July. So, I mean, that is a pretty big span of time to get back to the top. But look at the recovery, right? Look at the recovery is the point I'm trying to make here. Like, if you keep buying and dollar cost averaging down, and I know there's probably some people that have, second thoughts about doing a DCA strategy, but, maybe you lump sum, I don't know. There's hundreds of strategies out there. Like, how do you actually take advantage during a bear market without, doing any, type of trading? If you're like an index investor, you can do the DCA and that might make sense, or you can do a lump sum invest, whatever, right? But whenever you're going through these 5, 10, 15% drops, or even 20% drops, that's when you really want to like put a little bit of, fuel on the fire and like start dumping a little more cash in. You don't want to keep going in with these small DCA amounts. At least in my opinion, all right? I'm not a financial advisor, planner, etc. Those are people you should talk to, all right? I'm just some dude on YouTube. But, look at the recovery eventually, right? What came after this massive dip and this peak pessimism. Okay, so this was 2019 or 2018 into 2019 during this whole global trade war crisis between America and China. So excuse me, this was COVID-19. Okay, this was COVID-19. In a span of a few weeks, or a span of a few days, almost, it felt like portfolios dropped 34%. Okay, this, I believe, was almost a 19% drop from the peak to the trough. This was almost a 20% drop, and this was a 30% drop. Okay, so this is enough to test a lot of resolve for a lot of investors, and I totally get it, right? And it took us months to recover. It took us months to recover. From, let's see, this is mid-March all the way to, let's see, almost August, right? Almost August is when we finally recovered. But look at all this growth. Imagine if you were dollar cost averaging or opening new positions in companies you like or buying ETFs that you really liked. This was a prime opportunity down here, or on the way down and then on the way back up, right? This was a prime opportunity. And of course, the same amount of news, well, I won't say the same news came out, but the same amount of news came out, right? Uncertainty, fear, doubt, recession, slowing economy, jobless claims, all that stuff was coming out left and right, because COVID was a black swan event. Nobody knew how to deal with it. The whole world shut down. So, this was, in my opinion, and I've seen, articles and kind of some studies done, that this was like the fastest recovery or the fastest bear market for something that was made, that was, I won't say man-made, but it was when the whole world shut down, it was because of the governments that caused it to shut down, right? So that caused the stock market to go down tremendously. So that was like on purpose, versus other black swan events where it's like, we don't know those happen until they've happened. And then that's when new regulations usually come out. Think of like the great financial crisis, 2008, 2009, when everything was happening. It was only after the fact and after all the studies were done that it's like, oh, okay, we could have been caught that, but hey, since we didn't, let's add all this new regulation to make sure it doesn't happen again. So, all that's being tested right now. And then, just not too long ago, I think a year or two ago, we had the banking crisis, the regional banking crisis, where all these regional banks started failing, right? And it's, again, same exact thing. So this brings me to a chart from Vanguard, right? I like reading Vanguard white papers because they're really nice, really helpful. I think people should spend some time reading these white papers that these larger institutions offer, because, they just offer a good perspective. So this was, bull and bear markets over time. I hope you guys can see that. Let me make sure. Here, guys. I just want you to be able to see this. Okay, I think that should be good enough. Okay, so this was COVID-19 right here, right? This was COVID-19, 25%, right? A 25% drop in 3 months, right? Took a year and 3 months for, hold on, I'm reading this chart wrong. Okay, so this is the preceding bear market. This is the preceding bull market. So we had a bull market for 4 years and 9 months after a 3 month bear market, right? Where the stock market dropped 25%. And then even before that, the global financial crisis, we had a bear market that lasted a year and 4 months, but the preceding 10 years and 10 months, we saw a 222% gain, right? And you just keep going back, and you can see that for every bear market, the market has recovered, right? The market has recovered and done exceptionally well. So yes, the pain right now is horrible, and seeing, your blood being drained from your portfolio is pretty bad, blood in the streets and all, but you got to just hang in there. You got to just stick to your strategy, whatever that strategy was, or whatever that strategy is, stick to that. If you have to change it, don't do it because you're emotional, right? You have to keep your emotions in check. That's another big one. A lot of people get very emotional during these downturns, and they start selling and really cementing those losses. You know, if you had a portfolio of, let's say, 100,000 and it dropped $30,000, right? So now you're at 70 and you're worried it's going to keep going lower, and then you hit sell. Well, now you just really sold and you cemented those losses. Like you have no chance of a recovery at that point, right? You sold it. Now you're waiting, and you're going to wait. You know, I love hearing this because I read it in the comment sections of other, you know, articles, videos, and things like that. Well, just wait until the bottom. Wait until the bottom. Nobody knows when the actual bottom is. And by the time people figure out when the bottom happened, it's already too late and the market's already well on their way to recovery. So you've already missed that opportunity. So my point is, you know, stay invested, you know, as much as you can, especially right now. Now, this obviously won't apply to people who are trading or doing that kind of stuff. I'm speaking specifically to the investors who are buy and hold long-term types. So just my thoughts in all of that. So again, here's another chart for all the bull and bear markets over pretty much over all the you know, since what was it, 1958, right? Since 1958, bull and bear markets. I like looking at this chart again whenever things get really saucy in the markets, because again, you know, this is nothing new. Things like this happen all the time, and what happens and what comes after this is green days. I had, let's see, I went through, I was investing during 2020, right? So I had a portfolio, it dropped substantially. I saw pretty much, you know, a little more than half my net worth just completely evaporate, or a third of my net worth completely evaporate in a couple of weeks, right? Absolutely terrifying. But, you know, I was still buying. I was still putting money in the stock market. I was only buying index funds at that time. I actually sold out of all the REIT positions I had right before that drop. Don't ask me about the timing because it was sheer luck. And then, you know, the drop happened. I was in the index, dropped 30%. And, you know, I just kept adding money to that index. Eventually it all recovered, and I ended up getting the money out at a huge gain and ended up buying, you know, real estate. So again, guys, it's scary as hell right now. It's worrisome. The news is nothing but negativity and just like fear mongering. But be a long-term investor, have a long-term outlook. Things will be fine. The stock market is not going anywhere. The United States is not going anywhere. All right, control what you can control your emotions. Don't worry so much about people commenting doom and gloom and recession this, depression that, stock market crash this. Like, you know, I hate to use this phrasing, but, you know, opinions and are like assholes. Everybody has one, right? Even myself, I have my own opinions. I have my own biases about the stock market and how to navigate during these times. I'm just basing a lot of it off of the reading I've done, the research I've done, and the actual experience that I have having lived through this. And I see from the comment section, we have some people who've been in the stock market for a few decades. So, you know, they're saying kind of the same thing. All right. So anyways, all right. So that's going to do it for this section of the stream. We're going to just go quickly through the markets, and then we'll end it off with a portfolio update. All right. So I hope this is at least, you know, helping some investors out there, maybe some new investors, you know, work through what's going on. Be long-term, have a long-term mindset. Again, I hate beating a dead horse, but yes, this stuff happens all the time. Don't be scared. Don't let your emotions take control of you. Do not hit that sell button because you're fearful of it going, you know, to complete zero. I mean, yes, if you're invested in maybe like some, I don't know, some penny stocks or something, I don't know, maybe there's a chance there. But if you're investing in like even the Mag 7, if you're investing in these tech stocks, like they're not going to go to zero. You know, these ETFs, these, you know, large cap, mid cap ETFs, you know, S&P 500, you know, Russell 2000. What else we got out there? VNQ, we have, let's see, a total market index. I mean, these things are not going to zero. QQQ, which tracks the NASDAQ 100, this is not going to zero, right? As it continues to drop, look at it as like, holy crap, all these things are on sale, because as they drop, just for it to recover, you know, if we drop 20, 30%, just on the recovery, for every dollar you put in there, you could be making 20 or 30 cents on every dollar. And then whatever comes after the recovery will be profit, like really a lot of profit, right? So if we hit, you know, recovery, 10, 20%, we recover, and then it grows an extra 100%. I mean, there's your return right there on every dollar invested during the downturn. So again, be very mindful of this stuff, guys. So here's the market. I know it's all going to be red, right? But this was crazy. I saw the drop overnight. You know, you guys were obviously all asleep, but I saw the drop and I was like, holy hell, this is going to be bad today. And it was, but again, nothing new here. All right, so S&P 500 down 4.84%. NASDAQ dropped 5.41%. Bitcoin, man, I don't know what Bitcoin is doing, but it's doing something. It had a huge spike right before the announcement, right? And then after the 4:30 p.m. talk Eastern Standard from President Trump announcing the tariffs, the thing just collapsed, right? It just collapsed. It looked like it was going down. So, I don't know if there's any Bitcoin holders in here, but I tip my hat off to you guys because, again, volatile asset, to have diamond hands for this thing is crazy, right? You never know what you're buying. Like, is this the new high? Is this the new low? Or can we go lower, right? There's a lot of people out there that say, we're heading into crypto winter, right? So if you're a long-term investor, this could be a premium opportunity for you, right? If you want to wait maybe a little longer or buy some on the way down, entirely up to you. But this could be a premium opportunity for a lot of investors. Tom Lee, who's Fundstrat's, I think he's not the CEO, but Fundstrat's like chief investment officer, I think is his title, or strategist. He's predicting Bitcoin's gonna be at 150,000 by the end of the year, and he's maintaining that. Now, very optimistic, very, obviously that can really get you excited, but again, take it with a grain of salt, because this, instead of being at 150, we could be at $43,000 a coin. Maybe MicroStrategy will get liquidated or something, and they'll have to sell all their Bitcoin, and that'll start the cascading effect of just Bitcoin going down. Who knows, right? Nobody knows, and certainly not I. Gold, obviously the best performing asset year to date, continues to rip new highs. Man, it still blows my mind that gold is just killing it right now. Gold is killing it, absolutely killing it. And again, it just shows where investor mindset is at right now. Investor pessimism is very high. A lot of people flocked to gold as a hedge against a couple reasons. One is equities to get away from the stock market. Two is value of or devaluing of the US dollar, right? So that's why other people flock to gold. And another reason is for inflation. So it's just interesting that gold just continues to rip new highs. 10-year treasury going lower. Thank God the 10-year treasury is going lower. I say this every stream because it's just so awesome to see this continuing to reach new lows. Again, Scott Bessent, Secretary of Treasury, is on record for saying that he and President Trump wanted to focus on bringing the 10-year treasury down because they couldn't force or influence the Fed to do it. So they're going to do it some other way, but like putting tariffs and crashing the economy. But anyways, I digress. Having the 10-year treasury go down is obviously very good, but it was not good for REITs, right? It was not good for REITs. REITs were also a part of that bloodbath. REITs had a huge sell-off, right? 3.4%. That is huge, right? But me being a REIT investor for these last couple of years, I mean, the last couple of years have been nothing but a bear market for real estate. So this is like whatever to me. I mean, this is a huge drop. Don't get me wrong. This is a really huge drop. Anytime an index drops or an ETF drops about 1%, you can probably bet that the holdings dropped a lot more. So obviously dropping almost 3.5% was a big deal. So let's hop into the portfolio, and I'm just going to kind of explain, kind of what I'm doing, just to remind everybody, and kind of just give you my thoughts on how I'm approaching all of this, because yeah, it is scary, but it is an opportunity, right? It's a very good opportunity to pick up shares on the cheap of of companies that you like, right? Of companies that you want to stay invested in with for the long term. Just checking out the comment section real fast before I do. Let's see. Let's see. So RB says, "Oh, Army PBC, absolutely." Mike says, "Hit that like button, appreciate it." Certified free. I'm doing whatever you're doing. No, please do not copy me. Let's see. Always be selling. ABC. Always be selling. Maybe it should be always be cover calling. I don't know. ABC. Always be continuing something. I don't know. Rook says, probably will have to roll over my 4 or April 11th puts. It's okay. Pay back some premium and immediately receive new premium. See, that's what I need to start learning to do, is how to do these cover calls so I can start getting some of that sweet premium. No panic sells. Absolutely. DCA from RB. Absolutely. James Mag says, DCA is what I'm doing for now, a little bit each day. That's perfect. You know, that's, again, I know it's like old man style investing. And there's all this talk of this new way of investing, right? If you guys watch Citizen of the Year, you know, he puts out a lot of funny content, but he's always talking about this new way of investing, right? Investing in high yielding, NAV eroding ETFs is the new way to invest. But, you know, the old ways work just as well, you know, dollar cost averaging, you know, maybe a lump sum here or there. Your margin to the ankle, you actually margin, James. Congratulations. Join the club, man. That's what I'm talking about. We need to all be margined. Not really. Please don't, you know, use it very responsibly. Galveston County Mike says, back in the 1980s, I DCA'd into mutual funds like Fidelity's Magellan. Oh my God, you got into the Magellan Fund. The Magellan Fund, for those who are not privy to that, the Magellan Fund was ran by Peter Lynch, who wrote the book One Up on Wall Street. And he returned on that Magellan Fund, I think like 100, like, I don't know, it was some insane like number, like for a mutual fund and for a mutual fund manager to make those returns. But in his book, he details like basically how he ran the Magellan Fund, because I think the Magellan Fund had like a couple thousand stocks or something, but he wasn't doing anything like crazy. He just bought stocks that were very popular, like of products that people use to buy every single day, right? It was a very huge success for Fidelity. But yeah, Peter Lynch, great author. I recommend everybody read his book, One Up on Wall Street. And he did another one. I forget what that book is called, but yeah, anything by Peter Lynch. He also has a couple interviews on YouTube. Totally worth it. And he market crashed in 1987. I bought more while it was on sale. This was the learning moment for me. Yeah. And Peter Lynch talked about that. He talked about when the Magellan Fund had a huge sell-off. And you know, he just kept telling investors, like, don't worry about it. Like, stop looking at the ticker every single day. You're going to be just fine. And then after that, the Magellan Fund took off. So awesome. James Max says, totally, I paid off all margin back in February and made a small margin buy this morning. Feels good to proceed with caution. Yeah, I would caution a lot of people to be very careful with their margin at this point. There's a lot of talk about de-risking portfolios. I didn't get that memo. Instead, I double margin to the tits. So it is what it is. I'm stuck with it, but I'm not scared of it, right? Because a lot of the money that I took margin from is tied to like some type of index. So if the index, unless the index drops, and it's completely possible, but unless the index drops, you know, 40%, I don't think I'll be getting a margin call anytime soon, right? So I should be okay. Of course, you guys will know if I'm not, because I'll just stop streaming and I'll just completely close the channel, and then I don't know what I'll be doing after that. I'm just kidding. You guys will see it firsthand. Galveston County Mike says, never wait till the bottom, buy what you can afford at the market slides downward. Yep, excellent advice. Patrick Bowers says, I start off with ETFs June last year, no single stocks yet. That's the best way to go. I had a comment in my Instagram. A friend of mine basically reached out and was like, hey man, thanks for basically telling me to buy VOO and just continue buying VOO, right? VOO is the S&P 500 from Vanguard, ticker VOO. And, it's like a no-brainer. You don't have to think about it. It's an index. You know, it has 500 of the largest US-based companies. You know, if, I don't know, Apple goes bankrupt, who cares? They'll just replace Apple with a different company, right? Like it's a self-cleansing ETF. It's completely passive. And not only that, you know, most ETFs, most index ETFs have very low expense ratio. So you can hold this bad boy for years, if not decades, and pay a very, very small percentage, right, from the expense ratio. Now, when you're holding these higher cover call ETFs, you know, the expense ratio is about 1%. You know, that could be pretty high, right? That, you know, long term, that could be very high. But, you know, if they're paying out a lot of money, you know, maybe who cares? I don't know. You guys be the judge of that. You know, there is still that prevailing thought that higher expense ratios are bad. I'm now, because I was of the same camp, but now I'm kind of like shifting towards, you know, higher expense ratios is the cost of doing business, right? It's if the fund manager is able to provide those returns, then excellent, right? And I got that kind of mindset from O. So shout out to him. Crouching Tiger says always be selling calls. There we go. Let's see. Certified says I'm with you, probably rolling on the 10th. Rook says apparently the I'm not gonna mention that. Apparently the channel is scrubbed and gone. I don't know. I haven't really been checking his stuff out. You know, like I don't know. Like, my thoughts about him, I admire his enthusiasm for this stuff. Obviously, he's going about it the completely wrong way, and a lot of his followers have gotten burned. But this is, again, nothing new, right? You had a lot of people pumping crypto scams. Their audiences get burned. You had a lot of people pumping products and services and sponsorships, and they got scammed or they got harmed. I mean, this is really nothing new. This is why whenever I do my stuff, I try to take an approach of, obviously do not copy what I'm doing. I'm going to show you what I'm doing. But if I blow up, if my account portfolio blows up, you'll be the first to see it. And not only that, like, I am not a financial guy, a certified person in any regards. Everything I've learned has been self-taught, right? Has been self-taught, or I've actually lost money, and, this is what I call experience, right? That's the word we give our mistakes, is experience. So, this is how I kind of structure my channel. I don't like to do things like off, like people, let's see how to explain this. Like in his channel, and I don't want to knock him. This is why I'm not mentioning him, just out of respect. But in his channel, he will take a lot of advice from people who have no idea what they're doing. And then he will go out and do that thing, whatever that thing is, right? Like I remember there was this prevailing thought, move all your money to IBKR, right? Interactive broker, so you can get 1x your leverage, or get 6 times your leverage or 4 times your leverage. Like, bro, you're struggling on Robinhood right now. Why are you even worried about freaking moving your crap to IBKR? How about you get yourself out of margin calls, and then, but again, his audience was like, oh, this is a great idea. This is smart. And they're probably no better off. And then not only that, then you had another genius idea. Hey, put all your money into SGov, into an SGov ETF, a treasury ETF, so you can collect 4% yield, right? And then take margin against that. But margin cost 5.5%, right? 5.5%. You're not making any money. So I could go on and on about that community. And not only that, it is a police state over there. So, if you even have a question, and it may be like critical of a fund, a certain type of high yielding fund, that gives you max yield, they will just completely ban you and drag you through the dirt, right? It could be an honest, innocent question that might have a negative connotation to it, and they'll just drag you through the mud. So I prefer not to even really watch his stuff, or even interact with that community. But again, no shot at them. It's just, my own flavor. Anyways, County Mike says Magellan Fund made us a bunch of money back then. Yeah, nowadays it's really not all that good. Peter Lynch left. He retired from Boston, Boston, Mass. So yeah, he's living the good life now. Yeah, VU's great for a Roth IRA, completely passive, set it and forget it type of investment. Really any type of retirement fund, in my opinion. Like my 401k at the time was nothing but an S&P 500 index. I didn't want bonds. I didn't want small caps. I didn't want any. I just throw it in an index, S&P 500, and just leave it there, and then just put money in it whenever I got paid. Schooling ain't cheap, says Sauce Maker. What's up, brother? How you doing? I hope you're doing well, man. And by the way, guys, if you haven't connected with Sauce Maker, he makes some excellent sauces. I'm not gonna even cap there. I mean, some of the stuff I've seen looks really, really good. I do have a friend that is getting a batch. Let's see. All right, so got through the comments, guys. Appreciate the comments as always. Let's look at the portfolio, and then we'll wrap up this stream. So I had to change the colors because I like seeing green because it makes me feel better about myself. but really, we're really not doing that hot, right? Down $12,000. All right. I don't like looking at this. It just makes me hurt. Let's see if I can get this a little bigger for you guys. Boom. Okay. So This is my portfolio. I do still have the 1,000 shares of Ondas Holdings. Again, this is a meme play. This is kind of just a, threw $1,000 in there. I did cover Ondas Holdings at one point. Basically, they have two companies or two subsidiaries in their company, and it's Ondas Networks and then Ondas Autonomous Systems, which is drone technology. So I just put $1,000 in there. It's basically a penny stock. PLTW again, Palantir, nvda, xpay, xdte. These are S&P 500 ETFs. They're doing the worst, obviously, because they're getting hit hard. But nvda is also taking a massive beating. They're my worst performer so far. They're down 17%, or the NVW ETF from Roundhill is down 17%. So I am taking the losses. I am dealing with it. Let's take a look at really the biggest thing here, which is the margin, right? So I still have a lot of margin buffer to go. I started at, I think, $42,000, right? $42,000. So I'm still at 47. I still feel very confident that unless xpay and xdte, because these are the two positions that I took all the margin from. So I dumped all the cash. It was about $100,000 worth into xpay and xdte, and then I took margin from them, right? So I feel very confident because of the S&P. They're tied to the S&P 500. So I feel very confident. I didn't buy PLTW and NVW and then take margin against them, because these are very higher risk levered plays. So if they were to go down substantially in value, I would get margin called like crazy, and I don't want that to happen to me. So I am sitting on $21,000 worth of cash. I'm deciding what I want to do with it. If I want to put it into xdte and call it a day, or if I want to open a new position. I would like to put it into xdte, to be perfectly honest, or even xpay, or combination of the two, because I want to just continue collecting higher amounts of dividend income, which I can then just continuously put back in there. So that'll not only give me a little more margin, but also increase my buffer, right? Because I'm putting fresh, dividend money, fresh money into the portfolio, and it's not just margin. So that is kind of the idea behind it. And then as these recover, which would be nice, maybe I'll, like sell some shares here and there. I haven't quite decided, right? I haven't thought that far. I really do like xdte more than I do xpay, just for the simple fact of long-term thinking, long-term, planning, because xpay, they pay out 20% return of capital, right? So if you're to drop 100K, over 5 years, 20%, you're in theory, you would get your cost basis down and you would have a complete return of capital. The problem is the dividend income from after that is treated as capital gains, right? You're going to get hit with capital gains. And then not only that, if you sell xpay or anything from xpay, that will be treated as, a higher level of capital gains, because now you're paying basically 100% on each share. So that is kind of worrisome. Again, I haven't quite decided what I want to do with that. It's just, long-term thinking, long-term planning. Plus, this is a monthly pair. I do like xdte because it's a weekly pair. NVW and PLTW are also weekly pairs. So this was not by design. This was all completely by accident. So it's just nice that I get paid every single week, some type of dividend income. All right. So that is this portfolio. I don't have any pending trades on the list right now. I don't think I'm going to be really opening like any other thing. I did look at like IYRI, which is a real estate cover call ETF from NEOS. This one does look attractive to me. I do like the shares that it holds, or the holdings it has. Me being a REIT person, investing in REITs, I do like what it has. It's just, I don't know, like this I know is going to be a little more stable, and it has room to grow, especially as the 10-year treasury continues to go down, and as probably investors are going to start flocking to, safer assets, something like real estate. So that is just my thesis for IYRI. So I will leave it at that, and let's look at the other portfolio hosted on M1 Finance. Let me make sure I log in here. Okay, here we go. All right, so this is the other portfolio. Again, taking huge losses. Look at this. VGT down $34,000. It spiked it went from like, I think like $18,000 like not too long ago down to like 34 just in a matter of a day and a half. Like this was so bad. It still scares the living crap out of me. Like I kind of kick myself for not just putting the money into an S&P 500 index and calling it a day. But instead I wanted to be, I wanted to be cool and I wanted to get in on technology. So here I am paying that price, right? Paying that price for investing in a tech sector ETF like VGT. So REITs are still doing well. I'm still up in REITs. Nothing exciting there other than they're just doing whatever REITs do. And the only exciting news that came from there is Crown Castle Inc. I keep calling it International. Crown Castle Inc., which is a cell tower REIT. They kicked out their CEO, and I think they just kicked out another high-level C-suite executive. So, they're doing some changes there. They just got rid of their fiber segment part of their business, which is good because now they're going back to basically cell towers. So that was really the biggest news that comes out of REIT land. Multifamily apartments, huge tailwinds. Building supply is very low for this type of asset, and the population's continuing to grow. People still need a place to live. So multifamily apartments is, I'm still very bullish on multifamily apartments. But other than that, there's really nothing exciting there. BDCs dropped 10%, which is, I guess kind of wild, but I mean, not really. I don't put that much money into BDCs. Someone did recommend, I think it was Income Baron. I don't know if you're watching, bro, but appreciate the recommendation. But he said I should look at PBDC, which has all these holdings. But I also looked at BizD from Van Eck. So I don't know. If I sell out of the BDCs, I'll move it into an ETF like that, so I don't have to really think about it. But I like being able to control the yield and be able to control if I want to put money into BDCs, I can choose, the best in class and not go with like some of the crappier ones. So I don't know. Just my thoughts on that. So outside of that, okay. Let's see. So Certified says PBDC is great, but doesn't have CSWC. Well, hey, the more I learn, I didn't even know that. I didn't see some of these other comments. Let me just go through them, and I'm going to end the stream after this. All right. Unless you guys got anything you guys want to add. Let's see. Steve says sauce review. Sauce Maker has the best job. I swear to God, the best job. Let's see, one ghost pepper at a time. I do like ghost peppers. I'm not gonna lie. I used to make this salsa out of habaneros. Habaneros are kind of hard to find here in Thailand. But Thailand has the Thai chili pepper, and that thing is just, man, that thing is so good. Like it just goes with everything. Like you could chop it up and throw it in eggs and it'll go great with eggs. Like, I don't know. I like the Thai chili pepper a lot. And Thailand is no stranger to spicy food. Like I think their three main ingredients is like, Thai chili peppers, and Thai chili peppers. Like that's really in every single dish you can find here. So I love spicy food. Let's see. Patrick says, I'll have margin once I hit 2K total in portfolio. That's required for Charles Schwab. Yeah, Patrick, just one thing, man, just be very careful. All right. When you're using margin, you'll see a lot of YouTubers, use it, implement it. There's also a lot of YouTubers who don't use it. Be very strategic in how you use it and really understand the ramifications of it, because while it can double your portfolio very quickly, you can also have, quadruple losses. So you got to be very, very careful using margin. All right. I'm not going to advise you use it at all. I used it, but my appetite for risk is far different. I mean, if you only have like a $2,000 portfolio and you're starting out and you're very new, I would really focus on adding as much money as you can, like actual fresh money to the portfolio before you even consider margin. And then even if you do add margin, look at it much later once your portfolio reaches, probably a bigger amount of dollars, right? And do not put your margin, and I'm just going to say this, certified financial advisor or not, do not put margin in high maintenance requirement ETFs or stocks. All right. That is what other YouTubers have done. And that is what some YouTubers, they started selling out of their stuff, or, they're portfolios basically imploded on themselves. So really be very careful with margin and how you use it. All right. But okay, guys, I think that'll do it. I appreciate you guys joining. I hope you guys have a great rest of your night or evening or day, wherever you are at in the world. I got to hit the gym today and try to get back into it. I already skipped like 3 days worth of gym time. Been running around here. I went to the aquarium yesterday in Bangkok. Really, really nice. I just had a lot of fun yesterday. So it was really, really just pleasant to get out of the office, get away from the condo. So, but other than that, guys, really appreciate you joining me for the stream. Again, be long-term, think like an investor, all right? Think long-term, have that kind of mindset. We will weather this storm. Okay. We're going to weather this storm. We will survive. Our portfolios are going to survive. Patrick, if you're, still brand new to this is perfect to be dropping a ton of money in right now, to be dropping as much money as you can into the markets as, something like VU, as, the markets continue to drop, because this is a great opportunity, I think, for someone like you who may just be starting out. I don't know what your actual portfolio is, but appreciate all of you guys. There's Citizen of the Year joining at the very end of the stream. I mentioned you a couple of times. Yeah, I mentioned your videos and how you talk about the new way of investing. So outside of that, guys, appreciate you. You guys all have a great night. Thanks for joining, and take care. I'll see you in the next